Hey, Rest. Hey, Holly. How are you guys doing? Good? Oh, hot? Yeah. Well, the days are only get hotter as we approach summer. So, um, yeah, I'm doing okay. Um, I did want to present your guys' plan last week, but I wasn't feeling too well. But now I'm doing much better. So, um, yeah. Yeah, actually, yeah, I was able to, yeah, the condo. It was actually one of the first items I looked at to help with managing your guys' cash flow. But on the topic of keeping it, well, you guys are not gonna like what I say, but especially after putting $400,000 into renovations. But I'd say it's best to sell it for $600,000 offer that you guys have now. But we'll talk about it when we get to it. Uh, so, shall we get started? Yeah. Mm-hmm. Okay. So for the first slide here, it's just the formalities, going over family information. You guys' age, salaries, and the amount of Social Security that's estimated at your full retirement age, which is FRA here. And of course, you guys are located in Louisiana, and these are your retirement goals: to retire at age 62, and then to live to age 95, rather. And of course, here are your lovely children, Blue, Black, and the twins here, and along with Dew. Yeah, I can imagine, having 5 kids can be a handful. Um, um, and so here is your goals and concerns. Now, your goals are pretty typical for families. Trying to fund for your children's education, along funding for your own retirement. But unique to you guys are setting up a special needs, an ILET or a revocable life insurance trust for Blue, and also deciding what to do with the first quarter condo. Um, and so for concerns here, you know, uh, wanting to have an adequate insurance coverage, um, determining an appropriate investment portfolio, along with creating a detailed cash flow analysis. Now, as we move through this presentation, um, actually cash flow analysis is throughout this presentation, so you'll see it. Um, and down here are just 2 notes about mortgage refinancing and having estate documents. Um, yeah, I just want to touch up that, you know, managing debt can be very helpful in um, with your cash flow, especially refinancing to a lower percentage rate. And you'll see it on the next few slides here. But yeah, I just wanted to mention it here. And so on the left here, yeah, this is just a financial snapshot, just showing your current financial health. And on the left here is your current facts. Yeah, on the left here, as you can see, after looking at your income statement, yeah, you guys are having a negative cash flow of 72,000, and this negatively affects all your financial ratios here. Um, having very little assets, being over leveraged, and not saving enough for your own retirement. So, your current savings is about 14% of your gross income, which is about 36,000. But to fund your retirement needs, you guys will need uh, about a 28 percentage, which is about 71,000. So now on the right here, if you were to sell the condo, these are the changes that will happen to your net worth, assets, and liabilities. So selling the condo will increase net worth by 64,000. Um, of course, selling it will decrease the assets, but it also decreases the liabilities, which is also big. And of course, most importantly, increasing the cash flow to 36,739, which is about 109,000 increase. So, yeah, selling the condo makes a big difference. Um, not just here, but also your financial ratios here too. Um, with having enough current assets to handle emergencies, reducing debt significantly, along with increasing your savings ratio. So as we'll get to retirement, um, there's about like four major periods that I'll mention, but here are just the big ones, just showcasing um, the savings ratios that you'll have, um, and onto the right here the dollar amount. So, and if you were to sell a condo, right, this will enable you to retire at age 62 with the goal of having a 200,000 retirement income. So, yeah, definitely. I know, right? Like you just put down $400,000 in renovation, but selling it, you know, will allow you to retire, you know, with your goal. So, yeah. And yeah, I just want to, since the idea is to sell the condo, I just want to talk about the tax implications, regarding um, helping you understand what basis is and how capital gains plays a role here. So, whenever you guys, or whenever someone receives an asset, right, or not receive, but just inherits, it's quite different. So, they receive a step up in basis, which is basically a new starting value. And so, since Rasp inherited the condo from his uncle BJ in 2010, the value was 600,000. And so, if the condo was sold at 600,000, that's the offer you guys are receiving now. There will be no tax consequences. And how does this relate to capital gains? Well, it helps close the gap. So down here, I guess I illustrated like a little example here. So if your basis is now 600,000, and if you were to sell it for 700,000, right? The result is that the excess 98,900 will be taxed at 15%. So this excess amount here, 1,100, will be taxed at 15%, which the real result would be that you'd pay $165. And here are the long-term capital gains tax brackets. So even then, you're paying $165 for something for 700,000. That's that's amazing, because of the fact that the basis helps up quite a bit to jump up to or to close the gaps, right? The capital gains tax brackets here. Yeah. So, and this also, not just with real estate, but this also plays into effect with investments too. Um, but in order to achieve this tax bracket, you must have held the asset for at least 1 year. So, but even then, the tax brackets are pretty low compared to ordinary income rates, which is like 12%, 22%, 24%. So this is what makes investments such a, um, I guess, a desired strategy, right? Because of the smaller tax brackets, or yeah, yeah. So yeah. So you saw the last slide just showcasing, right, the understanding of basis and capital gains. But now I just want to showcase the benefits of selling the condo. So right off the bat, if you were to sell a condo, right, this would remove about 83,349 a year from you guys' cash flow, which is increasing by 83,000 rather. And then next step, right, would be to try to refinance your mortgage, because currently you guys are sitting at 6% rate, but current rates are 4%. So if you do refinance your mortgage from 64%, it would decrease your mortgage payments by 1,300, from 3.2 thousand to 1.9 thousand. I mean, what? 3,200 to 1,900. Sorry. Yeah. And of course, again, just to reiterate, it would result in an increased annual cash flow of from 72,670 to 36,739. Right, 109,000 total increase. And so, yeah, it will address these needs, right? It will address the auto loan that you guys currently have, um, the adequate insurance coverage, and also funding for your emergencies and the state documents, along with, of course, funding for your special needs, education, and retirement. And down here, it's just a chart showcasing the action that would happen if you were to sell the condo and do a mortgage refinance on your home, right? After all that's said and done, well, along with clearing out your guys' credit card debt, the left amount will be 2,000, more or less, probably less. Yeah. Yeah, I know. So just 400,000. Yeah. Again, you just got it done, and so you would think uh, the market prices that, or the offers you would get would be close to 900,000, but sadly, market's been tough. So um, yeah, and so taking the offer, looking at the changes here, would probably be for the best. Okay, so um, with selling the condo, right? I mentioned about mortgage refinancing. So current bank lending rates are 15-year at 3.5%, 30-year at 4% rate, and of course there's a 3% refinancing fees or closing costs. Now, I just want to show you guys, right? Just the effect it has from switching or from refinancing to 6% to 4%. It results in 15 about 16,000 in annual savings and about 465,000 in total savings, right? So if you were to compare your current 30-year 6% rate to the bank's 30-year 4% rate, these are the changes here, right? And I know, right, 356 months, it's fairly new. It's because you guys just got the loan, but of course rates have just dropped. So, um, but yeah, doing this is part of the next priority, because the amount of savings um, that can be done here, and of course, since the drop in value from 600,000 to 500,000, I did a little bit of a calculation here. 20% down payment, it will result in a 400K um, mortgage loan, which is here. And so in total, you need about 152,000 to refinance, right? 40,000 going towards paying down the current mortgage, 100,000 going to putting a 20% down payment, and about 12,000 3% of refinancing fees, which results in about 152,000. So, and I did want to mention about the reason of paying 40 or allocating 40,000 towards the um, your current mortgage is because of the fact that lenders won't refinance if your mortgage to home value or loan to value, right? LTV. Some uh, different combinations here, but the idea is to have the home or the mortgage value at least equal to the home value at 100%. So currently, the amount owed on your balance, on your mortgage balance, is 540,000, while your home's value is 500,000. So this results in a 108% current mortgage to home value ratio, and in order to refinance, you'll have to have the ratio down to 100% or less. And of course, putting down a 20% down payment increases the rates in monthly payments, or decreases because you're getting better rates, lower rates, and lower payments. Okay, and so I just want to go over your guys' tax situation. Um, on the left here is your federal tax return, and on the right would be your state tax return. Um, both initial steps are very similar, but the difference is that state has its own standard deduction compared to the federal standard deduction here. So after 401k contributions and deductions, your taxable income on the federal side would be 182,500, which is the 22% tax bracket. And after doing some calculations, your tax liability comes back to 29,778. And then using tax credits, having 5 children, so it's about 2,000 times 5, about 10,000 here, and a combined federal taxes withheld is 42,000, and this results in a tax refund of 22,956 on the federal side. Now on the state side, again, the top is very similar except for the standard deduction, which is it being less, and so taxable income here is 189,000 compared to 182,000. And for state, finding the tax liability is, or I guess tax due, is fairly straightforward. Since Louisiana, right, uses a flat tax of 3%, 3% of 189,000 is 5670, 5,670. And after considering both federal and state tax returns, this gives a net tax refund of 17,286. Sorry, I guess this should have been in brackets. I forgot to include that. But yes, this is a tax return. I mean, a tax refund. And I have some notes down here saying that choosing a standard itemized deduction is fine. Either is fine. It's just that itemized would result in a 34 high reduction, which is fairly negligible. But I mean, if you guys want to, you guys can. But for you guys' plan, I chose standard because it's simpler, and you have to worry about itemizing items. So, and then since you guys do have a huge tax refund, I suggest submitting a Form W-4 to your employer to update and reduce your tax withholdings. And yeah, and ideally, you do want your tax refund to be as small as possible, as a measure of cash use efficiency. So, it being this high, that's a lot of lost opportunity that it could be used throughout the year to fund you guys' goals or your expenses. Yeah, the reason why it's so high, it's probably due to the fact that child tax credits, right, it being 10,000. But because if you were to subtract 10,000, right, you would actually be 12,000, 30,000 overheld. But of course, with the tax 10,000 tax credit, you get 22,000. But yeah, so definitely submit a Form W-4 to your employers. Either RASP or Holly or combined, or just I think RASP would be fine. Just updating or reducing his tax withholding by 17,000, and that should be fine. Yeah. Okay. And speaking of 10,000 child tax credits, here I just wanted to illustrate that you begin losing child tax credit as a child reaches age 17. So in year 2036, right? Within 10 years, um, Blue will be age 16. But the next year, he'll be 17. And so when next year comes, next 2037's tax return comes, you'll be losing 2,000 child tax credit. So, right. And so here I just highlighted out the years in which it'll be the last year. The child is 16. The next year, them turning 17 and losing 2,000 in again child tax credit. And over here, I think I mentioned before, but yeah, there is four major periods that I'll be talking about. And so as you're increasing your 401k contributions and decreasing and having a decreased child tax credits, this will affect the net tax refund. And here, it should be, well, I guess this is for 36, right? Yeah, so this is the first. So this is for the first 10 years. You guys have a tax refund of 17,000 because of the fact that contributions aren't being increased. Because again, I'll mention this in the next few slides there as we talk about education, special needs, and retirement. But yeah, for the first 10 years, your guys' contribution will remain the same. But of course, for the next three major block periods, year periods, will then change focus towards retirement funding. So, and that will lead to an increase in 401k contributions, which should increase, right, the tax refund. But again, you guys will be losing child tax credits as the years go on. So here is just the on the right is just the an average of the net refund amounts that you'll get in these year periods. And by the time due turn 17 in year 2043, which is I guess here start of year 2024 or 2044, you guys will no longer be having child tax credits. So and I note down here, right, starting year 2026, if gross income is above 150,000, catch-up amounts cannot be used as additional tax deductions. So it's actually being capped at 24,000 that you can use as a tax deduction. And I just want to illustrate here, right, for Holly, because Holly she has a 4% employer match here. The 8,000 catch-up amount will not be used as a tax deduction since your gross income is 250,000. And yeah. Okay. So now, first things first is that managing debt along with insurance. Those are two things to consider whenever we try to analyze a financial plan, because this helps out again with cash flow, along with protecting your cash flow, protecting your health. And so, just to recap a bit, your annual net cash flow is 47,425, and this is a combination of refinancing your mortgage, or your net cash flow, and the net tax refund. And so, for the first year, we're going to be focusing on clearing out your auto loan debt and adding insurance coverage. And as you can see here, clearing out your auto debt will increase annual net cash by 6,600. And this definitely helps out later on for retirement funding and funding other needs too. And here it's the chart again, the showcasing, right. This will be this will be the first year. So we're going to be clearing out the auto loan debt and funding for the added insurance coverages here. So after that's said and done, the leftover the 5,000. So the leftover amount will be 5,385 after year 26, or I guess in year 2026. And now we're finally moving on to actually funding goals, right? Um, so after managing debt, which is refinancing mortgages and clearing out any debts that you have, offsetting debts, we can then begin on funding our goals or your goals. No, so this may seem kind of confusing or a bit overwhelming, so please bear with me. But um, so for the children, right? The children are going to be going to school 4 years, but Blue will be going to school for 6 years. And as you can see here, right? There's going to be an increase in college costs and an increase in duration, and that's due to Blue's, of course, learning disability, right? Leading to reduced course load, considering if he does need assistive care, tutoring, and other accommodations. But just to explain, right, how much you need to fund uh, college costs. Well, if you were to take 17,000 a year for 4 years at a 5% annual growth rate or inflation rate, total cost would be 64,780. And this if you were to attend college now. So, and same goes for Blue too, right? If you take 25,000 a year for 6 years at an inflation rate of 5%, his total cost would be 94,120. And this is if he were to attend college now. But since they aren't, right? Um, on the chart here is like PV, right? PV is present value or today's needs. So total PV, present value needs, total today's needs. So if you were to fund your children's education today, this is how much they will need individually and not together, 211,000. But of course, we won't be doing that. There's no current funds to, so we're going to be funding them or funding your children's education annually. So now, okay, you're gonna notice that these amounts are higher than these amounts here, and that's of course again due to the fact that these amounts here will be growing as the children are aging. So, you know, uh, if you were to attend college now for Blue, he'll need 94,000. But since he's not going to school now, he won't be until 13 years later. His future value needs or his total college needs will increase to 95,700, about a 1,600 increase over 13 years, which is not bad, but still, that's the power of inflation. So yeah, things will just keep getting more expensive. And but okay, so down here, if you were to take the individual needs and combine them, you'll need an annual funding amount of 24,500, but a total future value of 381,578, 579, right? And I did want to talk about, okay, so this is funding, right? But like, who do you place the funds? And you place them in an education savings account, which is or a 529 plan. And the reason being is that, for one, they're tax deferred growth, right? So you can withdraw them tax free. Of course, if they're used for college expenses. But tax deferred means that as they're growing, they won't count towards your ordinary income expenses or categories. Yeah, no, it's a bit strange, but yeah, there's about like 3 categories of like how income is categorized, but which is ordinary income, capital gains, and gift tax. So, but yeah, But yeah, so you would just open a 529 plan for each child, and so where do you find these accounts or 529 plans? Typically, states have them, um, brokerages and financial institutions. Um, they have them available, but the cheapest option would be to open up a state plan, a state's 529 plan, because well, I guess they're cheaper. But of course, again, brokerages do offer them as well. But um, to going back to like funding them, you can fund them equally. It's fine, and you can fund them in index or target date funds, which I'm sure it'll be a target date fund. That'll be like the default option, and that's fine too. But the goal is to um, do a beneficiary change or designation um, to the account that needs the funds. So what I mean by this is like, okay, each child will have their own account: blue, black, cherry, and current, and due. But as blue starts college, right, and if he needs college funds but he's short on money, you can do a beneficiary change on the account, switching it to blue, and then you can use that account's funds to, of course, um, fund the shortfall or fund the expenses that he needs. And of course, there's no uh, uh, penalty or tax implications going on. Doing a beneficiary change is actually one of the most common strategies. Um, it's fairly straightforward. So yeah, and this I just want to tell you guys about it if you guys didn't know. Because of course you guys can fund um, college expenses normally, through a brokerage account. But of course, if you were to pull money out of that, that would count towards capital gains tax, and of course you get taxed on that. In here, if we were to use a 529 plan, again, distributions are tax free if used for college expenses. So there is a difference in saving quite a bit of money here, right? 381,000. That's quite a bit here. So um, yeah, and that's 529 plans. Okay, so just to get back on like right. So since clearing out the out loan debt, we'll have an increase in 6,600, right? So in total, we'll have an annual net cash flow of 54,000, and this can be used, of course, to fund education. And here I have a chart showcasing the amounts being used. Not the whole amount, but some of the amounts here. 30,000 of annual of cash flow being used, and 16,000 of net tax refund being used. And of course, along with the leftover amounts from the funding of or clearing out the auto loan debt and insurance coverage, along with the condo sale leftover. So for the next 9 years, 2027 to 2035, you'll have I guess a surplus of $4. So this is a pretty tight calculation I was figuring out. But as you can see here, in total, the amounts that you're going to be using will exceed the 24,000, 500 that I was showcasing last slide right here. So 46,000 definitely exceeds the annual funding amount, and you guys should be fine, even considering Blue's higher college costs. So just note saying down here, leftover amounts will be exhausted and education and emergency funds are funded. Oh yeah, that's right. I did add an emergency fund here, just because that's also important to fund too. So that's here. So not only you guys will be funding education, but we also be funding an emergency fund too. And with the leftover amounts here from net cash flow and the tax refund, the leftover amounts will go to estate documents, special needs, ILIT, again, irrevocable life insurance trust, and insurance funding. But yeah, not too crazy. Yeah, oh yeah, it's gonna get definitely it's gonna get wild later on. And you'll see. But okay, so after education, we can then move on to special needs. Um, Again, the year is 2027, 2035. So again, likewise, same with education. We're going to be spending the next 9 years funding, um, well, now with special needs. But of course, since using so much of the cash flow towards education, we're going to have to be using or redirecting 11 and a half thousand of expenses, it being from entertainment, vacation, clothing or food or what have you, to help fund the special needs. Well, not the special needs, but the creating the estate, creating the estate documents, creating a trust, funding the trust life insurance premiums. That's the goal here. Yeah, it's the guaranteed universal life premiums. Yeah, it's a particular permanent life policy. Um, and of course, funding for the admin costs and the added coverage premiums. And so, yeah, the extra 11,000 helps out quite a bit to help fund the special needs and the state documents here, along with the you know insurance premiums. And yeah, so I did want to talk about uh, the lifetime costs for special needs individuals. The range definitely um, is quite large, from 2 million to 5 million, and of course it depends on their the disability's severity. So, impacting their independence, employment levels, how much assisted living and care do they need, and along with the housing medical needs, and again, along with any other accommodations. And yeah, so I mentioned before, about goal, the guaranteed universal life policy. And again, this is with the survivorship. So you guys mentioned about wanting to fund 12,000 towards a second to die or a survivorship life policy. Um, but looking at the range here, I'd say the amount that you're funding now, 12,000, actually covers a 2 million coverage, and that's only if you're selecting a guaranteed universal life policy, because this I guess type or universal life um, I guess policy, um, it focuses more on maintaining the death benefit amount and keeping premiums low. So this is the best value policy um, that you can get, right? For again, um, maintaining the death benefit amount and keeping the premiums low. And again, the 12,000 you're funding, right? It actually covers that 2 million coverage. So, and it's within the range here. No, a lot of permanent life policies talk about cash value. So I did want to mention it here about what it is. So cash value is simply the policy's reserve account. You know, it allows it to sustain itself um, through cash value, which means like paying management costs, operational fees. Um, so, but now, okay, that's the policies, on the policy side. But what can you use it for? So, not insurers, but insurees, right? Uh, they can borrow against it. You know, the again, the growth when they say tax deferred, right? I think that what it means is that whenever you do withdrawals, um, yeah, tax deferred, right? I think it's again the idea of like it grows without it being included within your income, so it's tax deferred. Now you can borrow against it, but of course you have to pay it back. You can actually withdraw the amounts, but this would reduce the death benefit amount, so you want to do that. Or it can be used to pay premiums, and this helps prevents the policy from lapsing during bad employment years. Whenever you don't have the funds to pay the premiums. So, and most often case, this is what it's used for, just to pay the premiums. Now, um, some policies, especially variable life and variable universal life, they have this investment feature for cash value, and again, it's used to increase cash value so you can borrow against it, which this does provide liquidity if you do need it, um, which is nice. It can be, but ideally, it's best to keep insurance and investment separate because the complexity and fees in the life insurance are higher, and you don't want to risk the policy from lasting due to having low cash value or the cash value being underperformed. So yeah, I just wanted to mention about alongside funding the special needs irrevocable life insurance trust, just talk about the lifetime costs for Blue, and if your funding amounts does or if the coverage amount is enough, right, for potential lifetime costs for Blue. And yeah, 12,000 seems to be enough. Again, this amount is quite high, but if Blue is able to, complete college, work semi-independently, and live or be away from assisted home care, then yeah, this amount could be below the average 3 million to about 2 million, 1 million. So it just depends on how severe his his learning disability is. So yeah. Okay. So with education, special needs, with clearing out the auto debt, adding insurance, funding for education, and funding for the creation of the special needs trust and funding its premiums, we can now finally focus on the final major goal, which is retirement funding. Yeah. So again, selling the condo is beneficial, right? It allows you to do all that. Um, and funding all your needs, but so yeah, you say you wanted to. The goal is to retire at age 62 with 200,000 in retirement income, which is about 80%, right, compared to the pre-retirement income of 250,000. So yeah, 80%, and having a Social Security of actually 35,000, because if you have a combined, or if you're expecting income to Social Security income to be 50,000 at full retirement, age 67, if you were to take an early retirement, this does reduce the Social Security benefit amount, and at age 62, the amount reduction will be 30%. From age 66 to age 64, there's about I think 6.67, right, reduction per year, which in those 3 years, the total reduction is 20%. But if you were to yeah, yeah, there's a whole calculation about it, but I think I've written it in the report that I sent you guys. But yeah, for the first 3 years, right, say 64 or 66 to 64, there's a 6.67 a year reduction. and then from age 63 to 62, there's a 5% a year reduction, right? So 20 plus 10 is 30% total reduction. Okay, and so I'm gonna be using the capital preservation model, um, and which means, right, saving a bit more to safeguard against longevity risk, because um, oftentimes retirees do outlive their retirement assets. So I did want to use this model rather. There's about three models. This is like a good balance, and so I often use this as a baseline model, right? Because I definitely don't want you guys to be running out of assets, especially you guys live to not age 95. So, and with the having no current investment assets, um, this results in annual savings of 71,202. So, um, for the first 10 years, because for the first year we used, or actually, going back to what is it? No, I don't know, education, right? No, no education. It was actually special needs. So with about 11,000 going towards special needs here, they'll use about 6,000, right, total. I think I have it here. Yeah. So if you were combine, 6,000 with 11.5, that's about 18,000, and this basically uses up all the entertainment and vacation funds or expenses towards um, special needs and retirement funding. So and after after looking at this chart here, maintaining the current retirement contributions, and while adding the 6,000 expenses to help fund, um, the result would be 28,482 deficit. And if you were to remain on this pattern for 10 years, um, the deficit will grow to 284,820 starting year 2036. And this is okay, right? Because um, retirement is still a ways out, about 26 years, but education and insurance, and along with the trust and all that, those are needs that need to be addressed sooner. And so this is okay for the deficit to grow, and they'll soon be addressed in the next few slides, right? So after spending the first year, first 9, 10 years with clearing out the auto debt, um, adding your insurances, education funding, creating state documents, funding, and creating the trust, along with funding these premiums, we could then now focus on retirement funding. And so after I combined net cash flow, net tax refund, and an increase in 401k contributions and decrease child tax credits, this is what this amount represents here, 55,000. Now, if you were to subtract the trust and its premiums, right, because this is going to be an everlasting constant. So that leaves us about 37,000 available for the next 4 years here, years 30, 36 to 30, 39. I know it's kind of weird, right? 36, 39. That's 3 years, right? Should that be 3 years? But no, it's actually 4 years if you were to count, right? From the years 6, 7, 8, and 9. That's 4 years. Going through the years. And then of course, going back, I do want to mention that for until your retirement, you're going to be allocating 14,000 expenses to help fund your retirement. So again, it could be through entertainment, vacations, clothing, or food, but this is necessary to help fund your guys' to help fund and reach your guys' retirement of age 62 with the retirement income of 20,000. So this is necessary. I did try to reduce the amounts here from the early years, right? From right, using 3,000. But again, we're already using all the necessary entertainment and vacation funds, right, to fund all the other goals, and we're still going to be using the vacation and entertainment expense to help fund retirement goal. And yeah, this does again does lead to a reduced quality of life, but it is necessary to fund your guys' retirement goal and other goals too. So now there's two charts here. There's A and B chart. A, just an overview allocation, right? This is just showcasing what the cash flow and expenses are. And chart B here is the actual allocation within the retirement accounts. So, and down here, just some notes, right? What's going on here, the allocations, and this is just showcasing the employer match. 4% of 24,500 is 980. This is this amount here, just being added onto it. But what's actually happening here, right, is the cash flow amount 37,235 with the added 14,000. This is the total you get here, 51,235. Now, if you were to redirect this amount towards 401k plans and Roth IRAs, about 13,000, right? It just put this up. You're adding us 6,500 in Rasmus Holly's account, which totals up to 13,000, and you're splitting this amount up, 7,500, into Rasmus Holly's for Roth IRA accounts. Roth individual retirement account, Roth IRA. And the X amount, right, 23,235, can go to a taxable brokerage account. So, yeah, and so since you guys are still below age 50, the catch-up bounce is impossible. And I'll yeah, it's the next slide. I'll mention it, the catch-up amounts. So, for the next 4 years, right, from 2040 to 2043, now you guys will be age 50, and this allows for the catch-up amount of 8,000 towards 401k and about 1,100 towards your Roth IRA. But okay, I do want to say that now you'll be age 50, and so the amount of cash flow you have now is 35,235. And again, this amount represents a combination of net cash, net tax refund, increased 401k contributions, and a reduction in child tax credits. And of course, the constant of subtracting the trust and premiums. And that gives us 35,000. And I did note here that 2,000 would be lost from child tax credits. So here, with being age 50, right, we can allocate even more into 401k, your 401k plans, and even more into Roth IRAs. All right, increase 8,000, so double that, 16,000, 1,100, double that, 2,200s, and a subtraction of 2,000. So let's leave this about 3,035 in a taxable brokerage account. Yeah, this amount 23,000 from last slide here, right? 23,035. And this is just even further breakdown because of, again, it's the catch-up amounts. I wanted to separate, instead of doing just an 8 years of constant the same contribution amount. I did want to increase the amounts here from, right, 24,500, 25,480, 7,500 to these amounts here. So I just want to separate or showcase the distinction that including the catch-up amounts, does increase um, um, the surplus amounts. Because the reason why, of course, this is a bit smaller than the prior 4 years is because, again, it's the inclusion, or it's the loss of child tax credits. So that's why the amounts are lower here. And again, first 4 years, 2036 to 2039, the surplus amount was 17,000. That gives us 68,000. And for the years 2040 to 2043, a surplus amount of 15,000 times 4, I think it's 61,332. And if you were to subtract this from the deficit, right, 2084, 820, that was the deficit we stated. This would be the remaining deficit here, 155,436. So, right, we're still not done here. Now for the next 8 years, shoot, does it say 24,000? Yeah, just forget it. Let's just say same here, right? 24, 44 to 2051. But this again, this is 8 years. But yeah, so this is now 2024, right? Once due begins college, 15,000 will become available, and so this amount is also being reduced again through child tax credits. But after the reduction due to trust and premiums, that gives us 44 to 35. And the ages here, right, are age 54 to age 61. And so, again, just showcasing, right, A chart, the overview allocation. B chart is the actual allocation within the retirement accounts. And yeah, 4% of 32,500 is 1,300, right? Added onto that is 33,800 here. And so I just want to showcase here, right, 14,000, 44,000 plus 14,000, 85,000 here. And if you were to subtract the or place or redirect them into 401k and Roth IRAs, you'd be left with 12,000 in a taxable brokerage account. Again, so this is the only years, right, that needs to be changed to the years here, 2044 to 2051, to 8 years. But after all that's said and done, right, you'll be left with a surplus of about 24,333. And from our prior deficit of 155,436, if you were to divide 24,333, within 7 years, right, you'll be able to break even from the prior deficit. So by age 60, year 2050, you'll have broke even. So, and this, again, this all goes back to selling the condo and refinancing your mortgage, along with clearing out your debt. And that's all necessary to help retire or meet your retirement goals, right? Age 62, retiring with 200,000 income. 200,000 retirement income, annual income. Yeah, I know. It's quite a bit, but yeah, it took me some time to try to, write all this out so you guys can actually see what's going on. But yeah, I know you're able to meet your guys' goal. But of course, this again requires you guys to allocate 14,000 expenses toward retirement funding. So you are decreasing your quality of lifestyle, but this helps meet your guys' retirement goal. Okay, so with all the funding out the way, we can now talk about you know, um, the nuances, right? So like having adequate insurance. Okay, so we can start off with life insurance. Currently, you guys are receiving a 50,000 group life insurance through your employers, which is about 100,000 total, combined both amounts. But if you were to look at the amounts, right, needed here, right, let's say if Ras were to die, right, and if the condo was sold, the mortgage was refinanced, this is the amount that you would need to fund like your goals. I mean, so your education, your special needs, trust, your retirement needs, you know, your mortgage debt, your living expenses, and your insurance premiums, right? So all of this, if Ras were to die, um, this is what you'd be left in the hole needing. Now, I say it here for 4 million cards, but um, I do say that I do recommend buying a 30-year term life. You know, 3.2 million for Rasp and 900,000 for Holly. Um, and these amounts are due to the fact that it should be 12 to 16 times your current income. And of course, this is an industry benchmark, but industry benchmark, that's typically like again just a benchmark for a usual general guidance, but individual needs are different. So now these amounts could be higher, but I just wanted to show you, like, if you were to follow the industry benchmark trends of using 16 times your income, it'll give you 3.2 million, 800,000 from a 200,000 salary to a 50,000 salary. Now, for your lifetime income, right? This is what the amounts would be: 5.2 million, 1.3 million. Total would be about 6.5 million combined from both of you. But again, there's again, so this is the total lifetime, or not lifetime, but needs. How do I say this? The total amount or cost needs until retirement, right? Because 26 years, this is what you would need. But if RASP or Holly were to die today, these are the amounts of lifetime income that would be lost: 5.2 million, 1.3 million. So now, if you were to combine industry benchmark amounts, 3.2 plus 8, about 400 million coverage. Now, I say that this is far from the 9.5 million needs your family, uh, for your guys' family's goals and needs. But this allows the family to lead a similar lifestyle. Because if you guys were to die with no life insurance coverage, well, I mean, with no, I guess, better coverage amounts, 100,000 would not nearly be enough to cover anything besides the funeral expenses. So everything that's listed out here, right? You guys want to be able to fund your education, special needs, to clear out the mortgage loan debt. So definitely, with having life insurance coverage, it clears out almost everything here besides your guys' own retirement. And that's how necessary life insurance is, and how paltry the employer amounts are. And employer amounts, employer benefits are is good, but it's definitely not enough. So yeah, it's quite a difference here. 4 million compared to 9.5, about 5.5 million difference. So if you want to increase the life insurance coverage amounts, you can. This was just showcasing the industry benchmark of 16 times your income. You can definitely talk to it with your insurance if you can increase the coverage amounts. But this again, these are just uh, industry benchmark amounts. Okay, so now we're moving on to disability insurance. Again, having employer benefits is nice, but the terms are quite weak. Just like with life insurance, for disability, you're getting right stated 65 coverage, right? But this is before tax. Since the employer is paying the premiums, your guys' benefit amounts will be lowered. So in actuality, you guys will have about 50% of your income after tax. And of course, it has a longer elimination period, right? So that means that before you're able to receive the disability benefit, um, this long period, 3-month period, will have to be um, covered by an insurance fund, right? So if you don't have that funding, it's you guys are gonna be in trouble. And of course, having a weaker any occupation definition. So this means that, right, with having a weaker any occupation definition, means that as long as you're able to do anything, right, so any work, you can get denied your disability benefits. So if you can, walk, ride, carry things, as long as you're able to do that in any occupation, um, you can get denied disability benefits. Now, what I do recommend is buying an individual policy, right, for both of you guys, and trying to increase coverage closer to 70% of your income, as high as you can. And so the benefits of doing this is that the policy is tied to you, right? It offers portability, and with you owning the policy, right, you can increase or have stronger terms, such as having an own occupation definition and having additional add-ons like a residual or partial disability. So what these two terms mean is that own occupation is that if you're unable to do your job, they'll be able to pay you the disability benefit. Now, with the residual partial disability, means that if you're still able to work, but will work with reduced hours, working part time, they'll be able to pay the difference amount. So partial disability, right? You're partially disabled, so they'll pay the difference if you were to work compared to working full time. As for the rest of the insurance that you guys have, I say here good, but in actuality, you guys don't have personal liability. So I did highlight this here, but again, I guess I'm kind of running out of a screen space, so I had to place it down here. But your health insurance is fine, low out-of-pocket maximum, low deductibles, and 20% co-insurance. So this terms, and of course it's unlimited too. So your health insurance is fine. Long-term care insurance, we can revisit that later. There is no concerning chronic health issues popping up just yet, so that's fine. Home and auto. Now these two are asterisks. These are starred here because these two are normally necessary for unlocking personal liability, umbrella policy, right? Pull up. So if you don't at least have the coverage, dwelling coverage to at least 300,000. Of course, this is if you haven't, but if you don't, right? Well, let me clarify. No, typically, right, for personal liability, you need to have at least 300,000 in dwelling coverage. And for auto, you need to have a coverage of 250, 500, and 100,000 for plot. Again, I wasn't sure on the terms of your home insurance details, so I do. I guess I'm assuming you guys have at least 300,000 in dwelling coverage. So the next thing, right, would be just to increase the auto coverage amounts. And by having these two reach these requirements, you'll be able to buy personal liability umbrella policy. And I recommend buying a 2 million coverage because of your guys' 0.2 total assets that you guys have. And the importance of personal liability, right, is due to the fact that if you were to get in a serious accident or have a lawsuit occurred against you because of your personal involvement, personal liability, right, or your home and auto coverages won't be able to cover such serious accidents or high cost lawsuits. But with PLUP, um, it offers that cushion, flexibility, right? After once you've exhausted the home and auto amounts, PLUP will kick in and be able to take care of the rest. Similar to like health insurance. Like once you reach your deductibles, your max out of pocket, um, the insurance will take care of the rest of the costs. And this is similar to health insurance in that way. Think of auto and home as like your out of pocket maximums. Once you've exhausted these amounts, then personal liability will kick in. So hopefully that analogy kind of makes sense. But yeah, and it's fairly cheap too. Getting a PLUP policy or a personal liability policy, right? It's like $15 a month. It's very cheap. And then if you were to add additional millions to this, right? Like let's say you buy 3 million, that's just another what, $15 added. So it's very cheap. And this is also considered, one of the best value insurances you can have. So okay, now let's talk about investments. So from your guys' risk tolerance questionnaire, um, it returned a pass score of 22, which indicates a risk-adjusted portfolio um, of 30% equities and 30% on fixed income, which is, in other words, a moderate model portfolio. So with this model, right, being a moderate portfolio model, the expected returns are 8.5, and the standard deviations are 10.2 or 10.1. But this would meet your guys' 8.5 internal rate of return or required rate of return. So yeah, the structure is fine. Now, if you're new to investing, um, investing can be overwhelming and as a new investor because it's like, okay, where do you begin? Which stocks to buy? Which funds to buy? Right? And like, what if the stock turns out terribly? Well, the idea with investing, rather than trading, is that um, you don't want to pick and time winning stocks because you just don't know, right? Things can just happen, and so trying to predict the future is just it's a losing game. So instead of trying to pick, time certain stocks, the idea is to buy a fund that owns everything, right? Like a index or a total market fund. So an index or a total market fund, right? It tries to mirror the market, which means that again, it tries to own everything, right? From U.S. stocks, international bonds, it owns everything. And by owning everything, right, it reduces concentration risk, which means selecting very few stocks and you know being at the mercy of them. So it offers that diversity with owning different, types of stocks from large, middle, to small, to international. This spreads risk and averages gains and losses. So again, um, owning everything. And the reason why this is such a popular and well-tested idea is due to the fact that, um, right, if you were to think about it logically, if the market were to fail, right, that means everyone is losing money, right? That means, right, the economy will go under. So, the possibility of that happening, and it has happened, right? So to be fair, it has happened. But if you were talking about like history, markets have always bounced back. So um, again, the benefits of owning everything, adding in diversity, spreading risk, and averaging your gains and losses. It's a popular, most tested method. Now, the two rules of investing, right, are to prioritize broad diversification and keeping fees low. And when we're talking about fees, right? It's like, okay, what kind of fees are you talking about? Sales fee, 1B fees. Well, the main fee that we're talking about is the expense ratio, right? And expense ratio is an annual percentage fee to cover management costs. So, right, if you don't have an idea of what to look for, um, this is basically the two rules that you should be aware of and be mindful of. Um, so, for example, right, since we're talking about expense ratios, there's typically two types of funds, right? Passive and active. Passive usually have lower expense ratios, 0.02 to 0.2%, and active funds usually have higher fees, expense ratios, and they're both interchangeable, but it usually has higher fees, 0.6% to 1.5%, and this drags down, net returns. And I'll show you. I'll showcase this next slide. But um, the reason why passive funds have historically performed better. It's due to the fact that these expense ratios have remained so low. And for example, right? So let's say, for example, you invest 10,000 for 30 years, right? And the expected return was 8%. And the expense ratios, right, for fund A is 0.5, and for fund B is 7%. So if you were to take into account these expense ratios, right, 8% minus 0.05, 7.95, 8% minus 1% is 7%, right? Now, the ending value of fund A would be 99,000, and the ending value for fund B would be 76,000. So, right, just the difference, of 95%, 0.095% fee difference results in a $23,115 amount difference. So again, higher fees drag down their returns. And I just wanted to showcase here, along with there being two types of management, management and funding, passive and active. There is two kinds of, I guess, fund that in actuality, I guess how they're operating, and they are exchange traded funds and mutual funds. So exchange traded funds, ETFs, are typically passive, having lower expense ratios compared to mutual funds, which are less passive and has a bit higher expense ratios. Another difference is that ETFs fraction ownership is tied to the broker. So if you want, let's say you're into, or you have an account with Fidelity, right? And you want to own Vanguard funds. Well, typically, to own Vanguard funds, right? Fractionally, you'd have to be, you'd have to have an account with them to buy fractional shares with their products, their funds. So, and then with mutual funds, right, you can simply invest a dollar amount. And fractional ownership is quite important to be mindful of, because of the fact that some funds can go for thousands of dollars, right? And so people often don't have that much to invest for one share, right? For one whole share of the fund. So um, being able to invest, just a dollar amount is very, very, very what do you call it? Very flexible, right, for the investor. And now going back to your portfolio model, right? Being a moderate one, 7% equities and 30% fixed income. Um, this is the idea of rebalancing, right? So, um, let's say you have $100,000 in your portfolio, right? So how do you allocate that? Well, looking at the structure, 7% equities and 30% fixed income, um, 70,000 should go towards equities and 30,000 should go towards fixed income, right? And this is all about allocation. So, and as years go by, equities typically appreciate and grow, whereas fixed income usually stay the same. But what rebalancing means, right, is selling what grew too much and buying what became smaller. So if you want to maintain the same portfolio structure of 70% equities and 30% fixed income, these are the amounts that should be rebalanced to. Instead of your portfolio holding 145,000 equities, it should hold 126,000. And instead of 35,000 in fixed income, it should hold 54,000. And of course, this is the ratio of 145,000 out of 180,000. 145 plus 35 is about 180,000. That's the total amount, right, invested. But if you were to split it up, this would be the allocation amounts to match your risk aligned plan. Because again, going back to your risk tolerance questionnaire, you returned a score of 22, which indicates a portfolio model, a moderate portfolio model of 70% equities and 30% fixed income. Uh, so rebalancing is quite important, right? Again, I have these points here, right? Is to keep your risk exposure aligned with your plan, and of course, it's typically done once or twice a year. Sorry. There is another fund that I did want to mention, which is a target date fund. And so, this type of fund, offers diversity, but it auto rebalances assets for you. So instead of having to do it yourself, it does it for you. And due to this rebalancing feature, the expense ratios are slightly higher. But there's a benefit though. Due to the automation nature, it reduces behavior errors, right? So uh, oftentimes people panic sell when there's a market downturn. With the automation feature, as long as you're contributing your amounts, it does the rebalancing for you, right? Without your involvement of trying to sell certain stocks, trade them, or chase certain trends, certain stocks. And 401k plans often default you to them anyways. So, right, if you were to okay, now that I'm kind of aware of what to look for in investments, right? Broad diversification and low expense ratios. Well, 401k, already does it for you by putting you into a target date fund. Um, and in some 401k plans, they often have a limiting feature because of the fact that the employer does it for you. So, if you were to do it yourself, you would have more options to work with. But this is a fine option. Target date funds are a fine option. So now, with back on topic with the idea of broad diversification and low fees. you don't really need many funds at all. Just three total market funds will be enough. So, even though I have Vanguard listed out here, don't mind. These are I'm not sponsored by them. These are just an example, right? And so I just want to show you or bold, right, certain text here to showcase the nature of the fund, because each fund has their own like investment philosophy, right? Their it's called the prospectus, and it's like detailing what the fund's goal is. So each fund has a goal, um, selecting certain stocks to fulfill certain needs, and so these funds, right, are fulfilling a certain need. So Vanguard Total Stock Market Index Fund, right, VTI. This is the ticker symbol. This is the expense ratio, and this is the trailing annual 5-year trailing annualized returns, right? And as you can see, most of these fees are quite low compared to, again, showing compared to active funds, which range from 0.6% to 1.5%. And yeah, so a VTI, right, is about the total U.S. stock market. This fund in particular holds about 35, I think, 100 stocks, ranging from various asset class types, such as large, middle, small, and international. So, no, not international. Sorry, my bad. It's just U.S. stocks. Yeah. Now for the S&P 500, right? This holds 500 of the largest U.S. stocks. So these two are U.S. stocks. This fund here is international, right? This offers exposure outside the U.S. market, such as Asia, Europe, and other emerging markets. And down here is a total bond market fund, right? Focusing on U.S. bonds, treasuries. No, just bonds. Sorry, not treasuries. So now you're wondering, okay, like how does this relate to my portfolio structure? Um, well, here, if you were to follow here, I guess a chart that I made, um, for an aggressive portfolio model, right? Your allocation structure would be 80% stocks, 20% bonds, 60% VTI, 10% VXUS, and 10% bonds. Again, this captures the U.S. stock market. This captures the international stock markets, and this is bonds. And this is just matching the allocation structure here. Now for moderate, 7% stocks, 30% bonds, right? Example here would be 50% VTI, 20% VXUS, and 30% bonds. And for a conservative, it'd be 50% stocks, 50% bonds. And here would be the allocation structure, from the fund itself to, an overview here. And here he just notes, right? She's telling you, capturing the U.S. stock market growth, and VXUS just spreads the risk globally to international markets. Yeah. Um, yeah, so it's quite a bit to take in, but yeah, investing isn't so bad, whenever, if you were to think about it, right? Because you're trying to match your risk-adjusted portfolio, your portfolio model, and simply, if you know your allocation, right, structure, stocks and bonds, you could then find funds, um, which are stocks, right, and funds that are bonds, and just simply split them up to meet the weight amount here. 70%, 50 plus 20 is 70%, 30 and 30. So yeah, it's not too bad once you get a feel for it, or understand how one should invest. But yeah, again, these two rules here makes it simple, right? Broad diversification and keeping fees low. Yeah, oh man, I know there's a lot to take in, right? But we're almost done, right? We're almost there. So we just got, I think, estate left, right? Yeah. So this should be the final slide, and then we got the summaries. So there's about 4 slides left. So, yeah. All right. So this should take about more than 10 minutes, but we'll be over soon. Okay. So now we're finally getting onto estate documents. Now, since you guys don't have any estate documents, definitely consider all these points here. Drafting a living and a last will documents. These are important for outlining your end of care medical needs and how your assets shall be distributed. And of course, with the last will is a bit more important than living will. I mean, they're both important, but last will is kind of more important because last wills allow you to designate, guardians, the trust documents, provisions, and a structure. Selecting executive trustee, and then by defining the asset distribution structure. So, last will covers these 4 broad points here, and these 4 broad points are pretty important, right? For caring for your children, determining how assets will be distributed, the rules and processes, selecting individuals, right, to take care of your estate and managing the trust, and outlining when and how much should an heir get, at what age, what's the amount, because children, young children, are immature, and so they can be quite impulsive, and this can often lead to financial abuse or misuse. So it's best to outline a structure where you're not giving all your assets to heirs immediately once you reach age 18, because again that could just lead to financial ruin because they have yet to build up the financial discipline to handle that amount of money. And second point here is to draft powers of attorney documents. So if when you do become incapacitated, and typically when you have a spouse, right, they have the inherent duty, the inherent power to take care of things on your behalf. But let's say you are single, or your spouse passes away, right, and it's like, okay, what then? It's the same deal with defining primary and backup guardians. You can define primary and backup agents to act on your behalf. So either financially or medically. And incapacitation means like you're unable to move on your own, act on your own, being in a coma, right? You're basically unable to handle your financial affairs or handle your medical needs. So this is kind of important. Again, typically you would think your spouse should handle that for you, but again, like what if you don't have a spouse? What if your spouse passes away? Then who shall handle things for you? And this is important to consider. Now I have update beneficiary designations here. This is pretty standard, right? It's like making sure your accounts are named and assets, so the assets shall be distributed accordingly, right? Because let's say you have married, divorced, and remarried, right? Some accounts may still be named to your prior spouse, and so this is important that the accounts are updated, right? Because even though, let's say you have heirs and beneficiaries outlined or designated in your will, because of law contract or contract law, beneficiary designations override last wills, retirement accounts, and I think on death accounts, right? Yeah, transferable or payable on death accounts. So because of contract law, beneficiaries does override these terms here, which is important, right? You think your last will is takes precedence, but no, it's the beneficiary designations that do. So precedence. This is very important. Now, for the special needs irrevocable life insurance trust, this is important again for funding blue support and making sure that the trust document is in line with the I guess rules, right? So it won't disallow any government benefits being disallowed from blue support, and meeting up with the state attorneys to help with this is definitely something you guys should consider. Um, so again, I'm sure you guys are aware, but I just want to mention that the irrevocable term here means that you're giving up asset ownership. So the trust now owns the assets, and this does help with credit protection, but it does um, have a bit of complexity to it. So that's why it's necessary to definitely meet up with an estate attorney to try to iron out the kinks in the structure. Okay. Now, yeah, we're finally at the end here. Just 3 more slides to go. So, okay, with everything said and done, right, with selling the condo and the benefits it brings, right? So, under current assumptions, using the base facts, you guys have a 0% chance of funding your goals, and that's a fact due to the fact that you have negative cash flow. So there's just no way that you guys that lifestyle or have or owning the condo is sustainable. And I say via Monte Carlo analysis. So this tool here, it basically gives us a projection, right? It runs 1,000 simulations and averages out values to give performance estimation. And this does it at 3 points and throughout many different ages. I highlighted 2 age points here, but in the financial report it goes through every age from retirement age to death age. So I just wanted to highlight retirement age and your death age. So yeah, as you can see here, there's two charts here. The top chart saying under current facts, there's a 0% chance of success. This is the if you're above the median, which is 50%, so above 30, or below the average, 20%, so below 30. And of course, you notice here that the numbers are in parentheses. This indicates that you have negative assets, and it's no surprise because the expense is just the condo expenses were just taking up way too many resources from you guys. So now with selling the condo, you guys will have a 100% chance of funding goals, right? Selling the condo, refinancing your mortgage, and instead of having these negative asset amounts here, you guys have positive asset amounts. So, and I highlighted these two numbers here because even when underperforming, you'll have 8.6 million assets remaining at age 95, or 4.2 million at age 62. Even performing below average, so right. So definitely, even with so selling the condo allows you to retire and even have assets to spare. Yeah, so I know it makes quite a difference, really. And so, even though, again, I'll bring to the point of investing 400,000 in renovations, um, since the condo expenses was about 83,000 within like 4 years time, um, after selling the condo, you guys would have made that difference back. So, um, selling the condo is the right option. It's actually the only option. And now, just yeah. So just recapping, right? Risk management. Um, Again, health, long-term care, health, home insurance is good. Life insurance is weak, right? Um, you have 50,000 through your employer's 100,000 total. The suggestion is to buy a 30-year term life with 3.2 and 800,000 coverages for Rasmus Holly. Even though this 4 million amount doesn't really come close to the 9.5 million lifetime needs or your family needs, it's still way better than 100,000 here. And now for disability, again, yeah, it's also weak here. Employer terms are weak, and the suggestion that I recommend would be to buy individual policy and increasing the coverage closer to 70% of your income for both of you guys. The add-ons here provisions would be to add a own occupation definition and a residual partial disability. And for the auto insurance, and of course I'm assuming home insurance, right? It is the dwelling coverage is at least 300,000. Um, the my recommendation here would be to increase the auto insurance coverage amounts to 250, 500, and 100 for a PLUP. And again, for personal liability, increase the coverage to or buy coverage of 2 million to cover 1.2 million total assets. And so I have a note here. So for planning, for 4,040 added annual cost was used for added insurance premiums. Yeah, so I mean it's not much, but it's added on top of what you guys already have, which is auto, right? Basically auto, and health, almost home. But still about 3 here. Okay, and recapping investments, estate, and tax. So, um, again, your portfolio model is 7% equities, 30% fixed income. And I do want to reiterate the 2 rules here: broad diversification and keeping fees low, right? And so you don't need many funds; just 3 total market funds is fine. One capturing U.S. stocks, the second one capturing international stocks, and the third one is capturing fixed markets or bonds, right? Fixed income. So, yeah. Then the goal is to try to rebalance annually to keep assets aligned, um, ratio assets aligned with your risk plan or your risk-adjusted portfolio. Estate documents, just to reiterate, drafts living last wills. This covers the guardians, trust distribution provisions, draft power of attorney documents, designate and define their powers, their scopes, draft special needs ILIT, irrevocable life insurance trust. So, trust document, just so that it's in line with government regulations from disqualifying government benefits from Blue. And so for this, I used 8,000 one-time cost for estate documents. And finally, for tax, I say that choosing standard itemized deduction is fine. Even though itemized does offer a bit higher deduction, I did choose standard as the planning method. So, and again, try to refer to the child tax chart that I made whenever you guys trying to figure out how much to reduce your tax withholdings. And again, I did for the I know going to the cash flow was kind of confusing, especially for retirement and all the other areas such as education, special needs. I did create a recap section within the written report. So definitely check that out. It should be near the end of the report. There's about 2 sections, one for all the rest and one for retirement, because retirement can be kind of messy. So definitely look at them. And yeah, that's it. I know this was a long presentation, but your guys' situation was definitely calls for it. It was a bit unique. considering keeping the condo and the effects it would have on it. And if you're able to fund everything, all your expenses and goals, and well, with selling it, yeah, I figured that you guys were able to. So, again, yeah, you guys just spent 400,000 on the renovations, but you have to make it back within 3 years because again, the expenses 83,000. That's super high. Trying to maintain that, and then your negative cash flow of 72,000, definitely not sustainable. But yeah, that was pretty much everything. If you guys do definitely have more any questions or concerns, definitely reach out. I'll be around. Um, hmm Yeah, you don't know how many times I spent trying to recalculate, making sure the numbers are right, especially with how um, your 401k contributions, your deductions were increasing, and then your child tax credits was decreasing. So it was, like trying to balance out how much are you actually receiving in total, uh, net cash flow. hmm Yeah, sure. If you have any concerns, reach out. I'd be happy to help. Um, but yeah, that's it. All right. All right. See you guys. Take care.